Welcome to Zero Noise, your quantitative weekly market bulletin. I'm Michael Alpha, your resident former volatility trader, part-time conductor, and full-time admirer of National Lampoon levels of chaos, preferably on screen, not in markets.
And I'm Bella Vega. Quick reminder, this is data-driven commentary, not investment advice. Subscribe if you want the numbers, the models, and Michael's attempts at humor, usually in that order.
For the week ending January 2nd, 2026, the S&P 500 delivered a weekly return of approximately minus 1.06%. The Nasdaq 100 fell about minus 1.75%. Europe didn't get the memo. The Stoxx Europe 50 was up roughly plus 1.76%. Year-to-date, the S&P 500 is up 17.7%, the Nasdaq 100 is up 20.9%, and the Stoxx 50 is up 17.5%.
Volatility moved with the tape. The VIX rose about 7.7% on the week to 14.51, which puts it at the 25th percentile historically, still a relatively low volatility backdrop. The VXN climbed approximately 14.8% to 19.75, near its median historical level. Translation: uncertainty picked up more in tech than in the broader market.
So we've got a classic split screen. U.S. equities took a small step back, Europe leaned forward, and implied volatility rose in the U.S. the way it usually does when risk appetite cools. But zoom out. This is still a pretty calm volatility level by historical standards.
And the gap between the Nasdaq's volatility and the S&P's volatility remains meaningful. That's consistent with sector-specific pressure in technology and rotation away from higher beta growth exposure.
Now let's talk regimes, because markets love costumes. As of January 2nd, 2026, the S&P 500, Nasdaq 100, and Stoxx 50E are all still in the low volatility state. The Markov switching model puts the low vol probability at approximately 89% for the S&P 500, 63% for the Nasdaq 100, and 79% for the Stoxx 50E, and these regimes have lasted 26 days, 8 days, and 25 days, respectively.
No regime changes in the past week, which is the key point. That stability lines up with subdued fixed income volatility and U.S. 10-year Treasury yields holding around 4.2%. Despite geopolitical noise, the model is still reading calm, not crisis.
All right, model versus market time. On the Garch side, the S&P 500's estimated volatility is 10.69. That's down about 1.14 over the past week and nearly 2.72 over the last month. The Nasdaq 100's estimated volatility is higher at 14.41, and it dropped by approximately 2.65 over the last week and 3.87 over the month.
Now compare that to implied volatility. VIX at 14.51 and VXN at 19.75. For the S&P 500, implied exceeds Garch by about 3.82, which sits at the 57th percentile historically. Noticeable, but not screaming. For the Nasdaq 100, the implied minus estimated gap is 5.34 at the 78th percentile. That's the more important divergence. Options are pricing more uncertainty than the recent realized vol dynamics would suggest.
So the punchline is, realized vol models are cooling off, but the options market is keeping a jacket handy, especially in Nasdaq land. And yes, Bella, I hear you. That's not a physics joke. I'm trying. On the positioning and flow side, investor sentiment still looks sturdy. U.S. equity funds took in $16.9 billion in the last week of 2025, and global equity funds saw inflows of $26.5 billion. Meanwhile, U.S. 10-year yields stayed around 4.2%, and fixed income volatility remained subdued.
That combination, strong inflows with only a mild rise in uncertainty, fits a market that's still constructive, but more selective. The low volatility regime probabilities we mentioned earlier reinforce that. Calm, but not complacent.
Geopolitics remains the obvious wild card. On Russia and Ukraine, diplomatic talks are reportedly 90% complete on a peace deal, but the hard parts are still hard: security guarantees and territorial concessions. Ukraine is asking for 30 to 50-year security guarantees, the U.S. is offering 15 years, and Russia rejects any NATO troop presence. That keeps European energy and grain markets on edge.
In the Middle East, tensions between Israel and Iran remain elevated. Renewed missile efforts and proxy rearmament raise escalation risk, and that matters for oil shipping routes even with current oversupply pressures.
That risk backdrop shows up in the defensive corners. Gold is near multi-year highs around $4,330 an ounce, supported by sustained inflows and defensive demand. The U.S. dollar index ticked up, and money market funds saw large inflows, classic hedging behavior. Oil is still subdued around the mid-60s for Brent and $57 for WTI, pressured by record production in the U.S., Brazil, and Guyana, even with OPEC plus supply freezes and geopolitical supply risks, like U.S. sanctions on Venezuelan tankers.
And there's a clear floor dynamic in energy. Supply disruptions from Venezuela's tanker blockade and Ukrainian drone strikes on Russian refineries help anchor prices near $60 per barrel. Add monetary policy uncertainty. The Federal Reserve's December minutes showed internal divisions after a 25 basis point cut. With a government shutdown creating a data vacuum, markets have layered in a policy error premium, contributing to a bear steepening of the yield curve.
Net-net, it's a market juggling optimism and uncertainty at the same time. Strong inflows and rotation themes on one hand, geopolitics and policy ambiguity on the other. Which is basically the financial version of trying to enjoy a comedy while someone keeps pausing it to read breaking news alerts.
Looking ahead, the big swing factors are straightforward. The outcome of Ukraine peace talks, any escalation in the Middle East, and confirmation of U.S. manufacturing contraction with the upcoming ISM PMI. Jobless claims falling below 200,000 suggests resilience, but slowing hiring intentions complicate the Fed's path. That's the setup for how volatility gets priced next.
Let's wrap it. For the week ending January 2nd, 2026, U.S. equities pulled back modestly while Europe pushed higher. Volatility is still low overall, but uncertainty rose more in the Nasdaq. Regime stayed firmly in low vol, yields held around 4.2%, and the big narrative remains the same. Investors are balancing strong flows and rotation with geopolitical risk and a slightly messier policy outlook.
Stay disciplined, stay model-aware, and don't confuse quiet with risk-free. Thanks for listening to Zero Noise. If you want more of this format, data first, drama last, subscribe, and we'll see you next week.